You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. Fed Chair Kevin Warsh believes the Fed's approach to communication the past 20 years has made policy less flexible and distorted otherwise useful signals from financial markets. After two post-meeting press conferences under his leadership, traders are still working out what this change means for the Fed's policy path and longer-term inflation. Meanwhile, the frequent public appearances of his FOMC colleagues are a helpful reminder that Warsh cannot implement every change unilaterally. On today's episode, we talk with Narayana Kocherlakota, former president of the Federal Reserve Bank of Minneapolis, about how Fed communication has evolved since the financial crisis, how policy guidance can shape economic activity today, and the optimal trade-off between transparency and policy flexibility. Stay tuned. Coming up soon, our interview with Narayana Kocherlakota. But first, a quick market update. Payrolls fell 23,000 in July, far below the consensus for positive growth of 80,000, with downward revisions of 103,000 to the prior 2 months. The bulk of the headline print came from a decline in local government education jobs, a category particularly sensitive to seasonal adjustment issues during the summer months. The unemployment rate fell from 4.2% in June to 4.1% in July. The Fed left rates unchanged last week, as expected, and made only a slight tweak to the policy statement. There were 3 dissents in favor of a 25 basis point rate hike. Chair Warsh's second press conference was another departure from what market participants got used to under his predecessors. His preference for less guidance sounded at times like his commitment to restoring price stability was more talk than action. The curve twisted steeper during the press conference, and 30-year Treasury yields reached another fresh high since 2007. Despite Warsh's desire to speak less often and less frequently, other FOMC participants kept making public appearances and elaborating on their outlooks for rates and the economy. Last week's PCE deflator for June confirmed the ultra-cool CPI data published a few weeks ago, falling 0.1% in the headline index and rising only 0.1% in the core. The advance release for Q2 GDP showed quarterly growth slowed to 1.5%, but most measures of underlying demand remain remarkably robust. Earlier this week, Treasury announced it would leave its nominal coupon auction sizes unchanged for the next 3 months and anticipates this will be the case for at least the next several quarters. One notable change to their policy statement is that rather than evaluating potential future increases to nominal coupon supply, it is now evaluating potential changes. It's hard to know for sure, but the word choice could open a path to lower issuance for some securities and higher issuance for others, rather than increasing supply across the curve. 2-year Treasury yields are down on net over the last 2 weeks, driven by a fall in oil prices and a less hawkish expectation for the Fed's policy path. As of recording, Fed funds futures are pricing in 28 basis points of tightening by the end of this year. The 10-year approached 4.75% last week, but has rallied modestly this week and is currently trading at 4.60%. That's all for the market update this time. Now our interview with Narayana Kocherlakota. Our guest today is Narayana Kocherlakota, former president of the Minneapolis Federal Reserve from 2009 to 2015, and currently a professor at the University of Rochester's Simon Business School. Narayana, thanks for coming on the podcast.
Thanks for having me on, Will. I look forward to the conversation.
Our topic today is Fed communication, how FOMC participants can strike the optimal balance between policy flexibility and public transparency. One of Kevin Warsh's biggest goals for reforming the Fed while he is chair is by changing how the Fed communicates. He feels that FOMC participants talk too much, and this can leave them committed to a policy path when ideally they'd be much more flexible. Now, the Fed has gone from being incredibly opaque early in its history to its latest approach that puts a lot of value in transparency. But I want to start our conversation with the financial crisis, when we first got a lot of the elements associated with today's Fed communication. Narayana, take us into the deliberations at the start of your tenure on the FOMC in 2009. How are committee members looking at monetary policy and the economy? And why did simply pushing rates to zero not feel like enough to a lot of people on the FOMC?
Those are great questions. It was a very difficult time. My first meeting was in November of 2009. I like to joke somewhat morbidly that the unemployment rate started to come down as soon as I joined the FOMC. It wasn't 10% though when I joined the committee. Inflation was subdued, and over the course of 2010, it was going to become even more subdued. It was going to run closer to 1% than the committee's preferred rate of 2%. And as you pointed out, interest rates were at zero. So I would say that when I first came on the committee, and even into the early part of 2010, even though unemployment is as high as I described and inflation is subdued, there is a feeling on the committee that interest rates being close to zero is something really unusual. It's an emergency response to an emergency situation. And there should be some discussion of when are interest rates going to start to rise. And actually, that is what the committee spent a lot of time talking about in the first part of 2010. Now, this became clear as we talked about this, not just within the privacy of the room, but also publicly, that our discussions about when rates were going to start to rise from zero were having a material effect on the economy. Now, why is that? It's because when investors are thinking about how much to pay for a 1 year, a 2 year, or a 3 year treasury, they're thinking about, well, what do we think short-term interest rates are going to do over that same time frame? And so the Fed's communication about, okay, we're at zero now, but when are we going to leave zero is really critical in determining the interest rates on the loans that really matter in terms of how much a car payment would be, for example. I think that over the course of 2010, we were at zero, but it became clear, I think, within the committee, to others faster than me, I have to admit, but that the discussions about leaving the zero lower bound were actually a form of monetary policy unto itself. Now, this had been talked about theoretically, and I'd say that the committee learned. I think Chairman Bernanke knew this pretty well already. He's a very gifted man, but I think it's a learning process for many of us, and I think it became clear to those in the committee that it wasn't enough to say we were at zero. What was really important was for markets to understand when we were going to leave zero, and actually even what was that going to look like. Obviously, leaving zero and going to 5% immediately is very different from 5 years to get to 5%. It became clear that it wasn't enough to say we were at zero. We had to talk about what was going to happen in the future. How were we going to manage the exit, so to speak, from the zero lower bound?
That's so interesting because when I look at the guidance from the pandemic era, it felt like communication was beneficial and that it allowed markets to know the Fed really intended to keep policy easy for quite a while. But you're saying that the Fed felt compelled to prepare markets for liftoff, which I think is really different. And it leads me to my next question, which is I think you can say infamous dot plot. It started in January 2012. The SEP had been published before the financial crisis, but didn't include projections for Fed funds. What were those discussions like when Chair Bernanke and the rest of the FOMC decided this scatter plot of dots would help the Fed achieve its goals?
It was recognized, I think, pretty quickly that it was imperfect. I would say that there were those in the committee, I believe, if I'm recalling correctly, it's some time ago, I was one of those. I actually wasn't too comfortable with the dot plot. I think there's two aspects of the dot plot. One is good, one is not so good. I think that the dot plot can be informative about where the committee is going to be going in the future. A lot of times, though, what gets emphasized in the discussions of the dot plot is the scattering of the dots. And that, I think, is certainly useful information, but is really sort of a sideshow. That's really just describing, the discussion within the room. There's heterogeneity of viewpoints. Of course, there's going to be differences of perspectives among people in complicated situations, as we found ourselves back then, and arguably we find ourselves now. I thought it was unfortunate that a representation of differences of opinions was being released as being an official committee communication. I thought it would be better to have some kind of collective forecast or projection. And actually, even more informative than just a projection is a discussion of how the Fed releasing information about how the FOMC perceives itself as likely to respond to economic conditions going forward. I think the dot plot Yeah, it's really fun for people who watch the Fed, but a lot of the information about just how scattered things are. Some people think rates are going to go up quickly. Some people think they're going to stay the same for a long time. That difference of opinion is really secondary.
Yeah, I want to go into some specifics in just a bit about times where the Fed communicated dovish and that stopped them from being sufficiently hawkish, or they talked hawkish when they inevitably should have been more dovish. But as far as the totality of the Fed's communication, is it more confusing than helpful? Do you think at this point, I mean, look at the dot plot and think of how many qualifiers and caveats you have to add for a member of the public to understand what it's trying to communicate? Or in the Beige Book, the difference between modest, moderate, robust, whatever. Is this all more complicated than it should be?
So the Beige Book, I think it's a qualitative exercise, and the words that get used are qualitative. It is, I think there's somewhat value in it. I would say it's mostly harmless. I would describe the Beige Book that way. In terms of the dot plot, I think that there are good reasons to go back and rethink the formulation of it. Eventually, the Fed has come around to highlighting what the median is among all the submissions to the dot plot. I think the Fed would be better off just releasing the medians as opposed to releasing the dots. I think the dots, it's informational about the difference of views about the within the committee. I always felt the right way to release a dot plot was with the minutes. Minutes tells you about where differences of views are. The immediate release should be with the summary of economic projection should merely be the median, because that tells you where the center of the committee is. And I think that's a much more accurate feel for what the committee thinks is going to happen going forward.
Interesting. I want to go back to that post-GFC environment when you're talking about the Fed feeling compelled to prime markets for liftoff. So as I remember it, the Fed and a few other major central banks, they talked for so long, a few years into the recovery, about how they were ready to normalize rates. They want to get policy off the zero lower bound. And for so long, the economic conditions didn't really warrant it. I even think that looking back, that was the case, but the central banks had talked about it for so long, it seemed like they had to deliver to maintain some credibility. Do you think that's a correct read of the Fed's hike in December 2015, or was that first rate hike truly warranted because the FOMC believed that the macroeconomic landscape justified a rate hike?
I was certainly opposed to the rate. I didn't vote in December of 2015. I voted the year before, and I wasn't at that meeting. I don't think the forward guidance was critical at that point. And I think this was a general ethos within the Fed. And you talk about the difference with the Powell Fed, and I think this was the big change. There was a concern in 2015 that they had to move before you saw inflation move. And so they were reading off improvements in unemployment and thinking, okay, the labor market's getting tighter. That's going to generate wage pressures. That's going to generate inflationary pressures. We've got to start to move ahead of that. That was a quote unquote lesson learned from the 90s relative to the 70s, when the Fed had been more proactive, more preemptive in the way it responded to inflation and had enjoyed better success in keeping inflation under control as a result. And if we fast forward to the Powell Fed, as you mentioned earlier, you see a very different approach, which is we're going to be sure to tell the public we're going to be super patient about responding to inflationary pressures. And, not to say I had any influence. Was long gone from the committee at that point in 2020 when the Powell Fed was making its critical decisions. But that was what I would prefer to see the FOMC do in 2014 and 2015. I don't think it was the past communication had bound them in at all. I think it's really more they had a particular vision of what had worked in the past, and then they tried to apply that again in 2016. And I think the lesson learned from that was what was true in the 90s wasn't true again in the 2010s. And this is a challenge for making policies. All you have to go on is your past experiences, and those past experiences may or may not be applicable in the current time frame.
So the more recent episode, of course, that people have in mind right now is the Fed's reaction to pandemic inflation. And it, of course, spiked in the spring of 2021, but the Fed thought it was transitory until Chair Powell testified in front of Congress in November. And then it took them until March 2022 to actually deliver the first hike. Do you agree with the criticisms that it was forward guidance that prevented the Fed from hiking earlier than they did?
I'll separate that into two parts. Either the Fed did move too late, A, maybe three parts. A, I think the Fed did move too late. B, I don't think it's that big a deal. I think they moved maybe 3 or 4 months too late. We hopefully have a system where that is not really going to cause a major problem. And I don't think that was the source of the issues. They did wait a long time. And I think they thought, as you suggested, they weren't alone in this, that the inflationary impulse was going to prove to be more transitory than it turned out to be true. And they were worried about downside risks. I think hindsight is always much better than foresight. And I think that the lesson of the 2010s was, and you see it in their forecast in 2020, that there are forces in the world that are going to keep inflation low, regardless of how low unemployment gets. And we can be safe in keeping interest rates low for a very long period of time. I think the right way to think about this is not about forward guidance. It's really all about lessons learned from the past, trying to apply them in the current environment, and the mismatch between what happened in 2010 and what's happening in 2020. And you look in 2021, you'll see people like Larry Summers, Olivier Blanchard, saying, wait a second, we're going to have a real inflationary problem given what the Biden administration is planning to do. They're using economic theory to reason that out, as opposed to simply saying, okay, let's just do again in 2021 what we did in 2010. So I think the Fed got fooled. There's no doubt about that. But I don't think forward guidance has, in my view, much to do with that. And I'll point to something that I think makes my point, which is in 2022, when the Fed did start to raise rates, they communicated that they were going to raise rates relatively gradually. And they chose over the course of 2022 to raise rates much more rapidly than they had originally projected they would. That proved to be problematic, of course. Investors, and Silicon Valley Bank in particular, was fooled by the Fed's communication about interest rates. But I think that the storyline that what happened as a result of the Fed feeling bound by forward guidance is, at least to me, it doesn't feel accurate. I think it's just more a very typical policy story. You look back at the past, you try to use the past as best you can as a source of information about the current environment, and it's an imperfect business.
I think that gets at a really good point, which is that communication forward guidance is, or over-reliance on it, I should say, is different than just getting things wrong. So sometimes I think what people are criticizing when they look back at that period is just that inflation wasn't transitory in the way that the Fed and the majority of market participants thought, because after Powell's testimony, when it became clear the Fed believed it needed to raise rates to fight inflation, financial conditions tightened in anticipation of future hikes. So interestingly, Fed communication, I think you could even say guidance, allowed policy to get effectively tighter months before the first actual rate hike. What do you think? Is that a hot take? Did guidance actually bail the Fed out of their predicament in this case because financial conditions tightened 4 months before the actual rate hike?
There's some truth to that. Yeah, that happens all the time in the Fed world. Speaking as someone who was on the committee, I would say it's better when the committee does it. So what do I mean by that? I think if you don't see it in the statement, you don't see it in the actual moves that the Fed makes. If you see it in the statement, I'm perfectly comfortable with it. If instead it comes from Chairman Bernanke, to pick on him a little bit, in May of 2013, testifying before Congress and saying, okay, we're gonna what you thought was QE infinity markets is not QE infinity. And that led, of course, to the infamous taper tantrum. I think that kind of communication that's more informal, less controlled by the committee processes, I'm not as fond of it. And so, yet I think you're right. The Fed was bailed out to a certain extent, that lead up to their rate hike in March of 22. But it's better, I think, from a governance perspective, from a communication perspective, and from an economic perspective, for that to be a little more regulated and by the committee itself making those decisions.
Is there something to be said for the argument that policy is more effective when there's some surprise to it? I know Warsh also thinks that leaving policy decisions more mysterious allows overnight funding markets to operate closer to what you might call fundamentals rather than Fed expectations. What do you think of that argument?
Well, I don't agree with that. I'll put it that way. I don't think it works. How we judge whether interest rates are at fundamentals or not is in terms of the medium-term inflationary pressures those interest rates are generating. If Chair Warsh at his first press conference highlighted, and a statement highlighted, the importance of price stability, I am absolutely on board with that. If the Fed's interest rate stance is at 5% and that's generating 2% inflation, that's the right interest rate. If the interest rate is 2% and those are generating 2% inflation, that's the right interest rate. I don't understand this argument about what fundamentals and money markets are supposed to be. It's really about inflation. We have to read that off of what inflation looks like. And who does that reading? That's Warsh and his team have to do that. I don't think there's a sense that there's a fundamental that is free of the Fed out there. I think as we go, I'm speeding through some of the history, which is fascinating, but going up to the current date. So I look ahead to the next week's meeting as we talk. In next week we're going to have an FOMC meeting. We're on Friday. The announcement of rates is going to come out on Wednesday, and there's still very heightened uncertainty about what the Fed is going to do. Is the Fed going to keep rates the same, or is it going to raise them? It's about 2/3 the probability on keeping the same and a third on hiking. That is the Warsh regime at work. And it buys credibility for the Fed in the Warsh sense that Fed's free to do whatever it wants now. It can't cut, but it can raise or not. It will be consistent with what markets believe. But that is, I think, at least some uncertainty about what the Fed's going to do in 5 days. But that uncertainty now plays out all the way down the chain. It means that you're going to have heightened volatility in markets. And more importantly to me, I care about the mandates. It's going to lead to worse economic performance as well.
Yeah, I think that's an important point to make, that the uncertainty itself leads to a higher term premium across the curve, and the exchange for that is more Fed flexibility maybe, and whether that is a beneficial trade-off, I guess, is for another discussion. But I want to point out that sometimes we're blending together forward guidance with all Fed communication, and maybe there's not all that much of a difference, but at the July 2022 press conference, Powell said policy was going to be determined meeting by meeting, and they were moving away from forward guidance. Of course, they still publish the SEP. They still talk publicly about the policy path. I understand why Kevin Warsh wants to move away from forward guidance, but the market is going to form expectations. So my question is it possible to say anything without shaping those expectations? If you point out inflation has been above target for 5 years, that sounds hawkish. If you say AI is going to be disinflationary, that sounds dovish. If the Fed goes into a regime with less communication, are markets just left to analyze the size of Warsh's briefcase like they did with Alan Greenspan?
I'm going to refer to the work of one of my professors when I got my degree at the University of Chicago in the 80s. One of the great features of my time there was I got to learn from Professor Robert Lucas, who was later won the Nobel Prize and one of the great figures of macroeconomics in the late 20th century. The main thing that macroeconomists have learned from Lucas, which Warsh is walking away from, I would say, the main lesson of the so-called rational expectations revolution that took place in the 70s and has flowed through macro since is the following. Expectations about the future policy choices matter for the economy today. Just as you described, markets are going to form expectations of what the Fed does going forward, and those expectations are going to matter for what happens today. If you want to talk about how you're choosing policy, you have to be thinking about how you're shaping those expectations. You can either do it in a determinative, deliberate, and thoughtful way, or you can do it randomly. Those are your choices. And Kevin Warsh, for some reason, believes that the random way of just waking up one morning and saying what is in his gut is the way to go. But it's a completely counter to what we've learned about what good policy looks like. Good policy looks like not just about communication about what you're doing in the moment, but about what you're going to be doing in the future. Because those market and the public are going to be forming those expectations. And that's going to affect their choices today. And the only way for you to manage those choices today and manage their response to your policy choice today is to manage their expectations. For me, the only way to do that is in a thoughtful, deliberate way and not in some random way.
So to that point of public transparency, your job as a regional Fed president was primarily to help your district's constituents. It wasn't just to vote 8 times a year on monetary policy. Do you think that role can coexist with a Fed regime that chooses a lot less communication about how they are determining policy?
Yeah, that's a great question. I would maybe push back a little bit on what you're framing of my role. I would view my role as facilitating two-way communication. I learned from my district what mattered to them, and You know, the state of North Dakota was in my district, and during that time frame, if you went and talked about high unemployment in Western North Dakota, they had no idea what you're talking about because they're in the middle of an oil boom where they couldn't find workers at all. So different parts of the country are going through different experiences. I think it's useful for the committee to hear about those different experiences. Some of that's in the beige book. So that's one piece of that is I'm bringing forward information from my district, and that will continue, I think, and hope under whatever new regime Kevin Warsh has in mind. The other piece is to communicate about what the Fed does. And I thought I tried to do a good job of communicating effectively about why the Fed was making the choices it did and what it was likely to do going forward. So this is getting to forward guidance. I think there's still a role for that, but it will be a diminished role. There's no doubt about it. And if you have 12 people going on around the country communicating to their districts about, oh, here's what the Fed is doing, you're going to get slippage in that communication. I will say the easiest fix for this, I said this in a meeting to Chair Yellen, a huge admirer of Chair Yellen's, but I thought it was a miss for her in the following about communication in the following sense. She's an awesome communicator and she didn't do enough of it. Chairman Greenspan is well known for communicating opaquely, but he communicated a lot. And then you'll drown out the regional feds. If you're talking all the time, or the governors, people are going to look at the chair always in terms of communication. So if Warsh goes on CNBC, it doesn't matter if Hammock or Logan are talking that day. It's Warsh that's going to matter. I think the way to drown out the noise from the regional feds is not by saying, oh, you can't talk, because they're going to talk. I mean, that's why else do they exist? It's by the chairman talking more.
Yeah, I keep coming back to the idea that it's really difficult to say anything without the market forming expectations, and sometimes it's a misinformed expectation, but when it ties into this idea of transparency, I want to point out 3 recent episodes where I felt like the Fed did policy approaches that you might think were mysterious. So in 2019, they had this mid-cycle adjustment where they realized low unemployment was not contributing to high inflation. And then in 2021, famously, they kept rates at the zero lower bound because they thought inflation was transitory. And then last year, they didn't get alarmed by low and even negative job growth because they thought that changes in immigration policy meant that break-even job growth was that low. And I think through all of that, if the Fed was not publicly communicating their thinking, it would appear very mysterious. And especially in times of political pressure, if they were doing something that seemed counterintuitive and it was along the lines of what politicians were telling them to do, I think that lack of transparency would really threaten their credibility. What do you think about that?
Wow, you've chosen 3 really good examples.
I do have the luxury of preparing these topics beforehand.
No, I admire your thoughtfulness. Let me talk about your last example, because I think it's a great example. I think that the Fed did a great job of figuring out, wait a second, how should we think about the employment? The employment data was incredibly confusing. I mean, in 2025. And the Fed has such great staff economists all around the system. And they put that human capital to work. And then that translated into, we're telling you about why we're doing what we're doing. It was really fantastic. 2021, they communicated. I thought the communication really hung together in the first part of the year. And then the second part of the year, it didn't hang together as well, honestly. The first part of the year, I think you could tell a story that inflation is going to look like it's transitory and we're worried about them. COVID still, unfortunately, Americans are not getting vaccinated in the numbers they should. And we're worried about the cycle of the disease. I think by the end of the year, so we've talked about it. Fed moved a little late. You see this in all of Powell's choices. Powell realized something really fundamental, which I don't know if his predecessors understood as well as he did. The only way to communicate effectively in a crisis is to always communicate. And I came on the Fed in 2009 after the global financial crisis. Fed did a lot of great things, but boy, those things it did were viewed with a tremendous amount of suspicion by by legislators, I should say, and by the public. And the problem was the Fed was not a trusted partner, either of the legislative branch or of the public. If you're always talking, you're always explaining what you're doing, and I thought, all 3 of Warsh's predecessors were great communicators, but I think Powell used it more and more Because he talked more, I think he talked more effectively. I think Warsh's plan of I'm not going to tell you what I'm doing. He's going to need to communicate sometimes. It's going to have to happen. And he wants to be that trusted partner. Like your examples, I think, as I said, 19 is, the 25 example, I think is especially compelling.
That's a great reminder at the onset of the financial crisis and the years after, how these really aggressive monetary policy decisions were misunderstood by the public, I think even unfairly criticized. But the Fed really had the obligation to explain what they were doing. And maybe you disagree with them, but at least you know where it was coming from and the framework they were working under. And that's an idea that some people put forth is, well, let's have all of this communication, the dot plot, etc., press conferences, only in times of emergency. And maybe there's some intuitive appeal there. I'm not really sure how you then decide when it's an emergency and not, and does that do something to monetary policy expectations? Do you have any opinion on whether it would be appropriate or even feasible to shift the amount of communication based on whether we're in an emergency or regular times?
Well, I have strong opinions, and I think it's not a well thought out idea in terms of trust and credibility. I think in terms of just a mechanical sense, it's very difficult to make it work. I'll give an example. So in November 2010, the Fed launched a second round of quantitative easing, QE2, and it faced a lot of pushback to that action, fostered in part by the current chair of the Federal Reserve. So there was this thought, well, we should actually have a press conference to explain what we did. But it was realized if you call a press conference, just the calling of the press conference itself is a signal that you're worried about something.
It's panic.
It's panic. And so that is the challenge. If you do it on a contingent basis, your very action of saying, oh, we're going to have a press conference is a sign that you've got a problem. I can see the following argument. Have a press conference. It doesn't necessarily have to be an hour long every time out of the box. I think we get into minute 55. I'm not sure the questions are as good as they are in minute 12. I have thought for quite some time the press conferences really run very long. But I think you have to have a press conference after every meeting. The reason Jay Powell went to that is that under his predecessors, we had press conferences every other meeting. And then we ended up with this notion of a dead meeting. You looked at market expectations and they knew nothing's going to happen at these meetings that are in between the non-press conference meetings. It doesn't make sense to, I think, have a contingent press conference vision. There's so many logistical reasons. The staff has to get practiced at the press conference cycle. They have to get practiced at helping you prepare for press conferences. You, as the chair, have to get good at it. The media have to understand what you're saying. All these things mean you might as well do it every time. I mean, that's all there is to it.
Former Chair Powell mentioned something about discussing potential reforms to Fed communication at the end of last year, I believe, and maybe even onward. But the committee was not able to come to any consensus. And what we've seen so far from Warsh's very brief chair tenure at this point is that he is keeping his lips sealed, but all the other participants seem to be talking as frequently as they used to. So in terms of the FOMC's procedures, how does the committee internally decide what the rules are on communication and guidance? Is it up to the chair, or does the committee have to agree to something?
Well, that's a great question. It's a little unclear. I think the press conference decision that Powell made, when I look back, it did seem like he had made it without formal committee approval. I suspect I wasn't on the committee at the time, but I suspect he had reached out to committee members and talked to them. But things like the SEP, there was a lot of internal committee deliberation on that. And so the press conference, I think the issue with it is it's the chair's thing. So the chair can choose to talk for 10 minutes, 15 minutes, no, or not at all. I mean, so it really is, there's a lot of chair discretion in that. In the SEP, I think the committee is going to have to, if you want to get rid of the dot plot, the committee would have to decide, I think, to do that. And I think there Warsh is hoping, and we'll see if that hope is borne out, that his task force will provide some intellectual support for his views on communication. We'll have to see.
So to close things out, if you were in charge, Chair Kocherlakota, what sorts of reforms would you make to the Fed's current approach to communication, if anything?
I'll start by saying I like task forces, and so I would absolutely be informed by what the task force has said, I think that's a really nice step that Chair Warsh has implemented. I hope he does listen to the task forces. I think that'd be really good for the organization. What I did like, so I liked stripping away all the layers that had built up over the years in the statement. But I thought it got a little too stripped down, and I think there has to be some communication in the statement about what the Fed is thinking it's going to be doing going forward, how it's planning to react to economic conditions. And the final thing, and I've said this for years, a target that is not time bound is a meaningless target. So to say we're going to have price stability over the long run and not tell me that's 10 years, 2 years, or 100 years is a meaningless statement. I would love to have communication where they were saying more about how long do they expect policy to take to get inflation back to target, and what they're working towards in terms. The important thing is, what are they aiming for in that regard? That third piece is something I pushed for a long time when I was on the committee and when I'm off the committee. And you'll see it at other central banks. Our neighbors to the north follow this kind of policy. Certainly the Bank of England does. But we were more opaque on that.
Narayana Kocherlakota, thanks for coming on the podcast.
My pleasure, Will. Thanks for having me on. Great questions. Appreciated the conversation.
That was Narayana Kocherlakota, former president of the Minneapolis Fed. I think that timeline since the financial crisis is a helpful reminder about why the Fed gradually increased its communication with things like more press conferences, the dot plot, and public appearances from FOMC participants. It helped the public understand the goals and operations of monetary policy, especially when decisions looked confusing or politically motivated. Less communication will have some benefits, but the FOMC needs to strike the right balance between flexibility and transparency. The CPI and PPI for July will be released next week and show whether the shockingly cool inflation in June was a fluke or the start of a more sustained downward trend. Gasoline prices should have a relatively benign impact on headline inflation after driving most of the change since the war in Iran began in March. The consensus currently expects both the headline and core CPI to rise 0.2%. The following week, the Fed will release the minutes from its July meeting on August 19th. Given the vague communication offered at the post-meeting press conference, these minutes could offer a lot more information than what was provided by Chair Warsh. The entire committee votes on the text of the minutes, so Chair Warsh will have limited influence if he wants to significantly decrease the size or scope of how the minutes report details of the meeting. A few FOMC participants are scheduled to speak the next 2 weeks, and we expect more will pop up as time goes on. Otherwise, the Treasury market should mainly take its cues from the economic data, oil market, and evolving AI sentiment over the next 2 weeks. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.